Hey, it's Jim, and this is FRM Part 1, Foundations of Risk Management, and the lesson on how do firms manage financial risk. You'll probably get used to me referring to the first sentence or two or the first paragraph inside of these lessons or chapters, but I'm going to do something different here. I'm going to skip all the way to the summary. The first sentence in the summary says something like, and I'm paraphrasing here, that this lesson was an attempt to come up with a logical way to think through the risk management process. Well, that sounds reasonable, right? But then the very next sentence begins with a however. However, there are no silver bullets and there are no easy answers. So that's kind of a signal to me that, boy, why are we even wasting our time if there are no silver bullets or easy answers? But this is what you should make sure you learn early on in the FRM program, that what GARP is trying to teach us is that financial risk management is both artistry and science. I mean, we'll do lots and lots of math, but this lesson is probably more of a focus on the artistry, taking a step back and say, okay, in that very first chapter, we learned about identifying and quantifying and managing the risk. And then we're going to take it one step further. We're going to say, how exactly do firms manage financial risk? And this chapter could be called, why do firms manage financial risk? Under what circumstances do firms manage financial risk? Where do firms? I can't think of any other words to begin. So this is a pretty comprehensive second chapter. Keeping in mind our goal is that you're going to be faced with 100 questions on the exam, and 20 of them, 20% is going to come from these first series of chapters. There's 11 of them, so I'm just going to round and say there are going to be 2 questions on this chapter. So we've got 5 learning objectives. And notice that the action words, don't say determine or compute or calculate. Compare, explain, evaluate, apply, assess. Well, assess could be quantitative, but it's not in this chapter. And so let's see if we can't come up with, let's say, 2 likely questions for each one of these learning objectives. All right, let's start with that first one. Different strategies that a firm can use to manage its risk exposures. All right, so this makes perfect sense. Now, we started the slide deck with this, even though this section is somewhere embedded in the middle. But what firms can do, or what individuals even can do, is let's go ahead and just accept the risk. In my investments class and my derivative securities class, we do lots of hedging with forward contracts and futures contracts and option contracts. And I always tell my students that in a lot of the examples that we do in class, we're just 100% hedged, just because in an academic setting, it's fairly easy. But sometimes firms will hedge 50% of the risk. So they'll transfer 50%, but they'll accept 50% of this. The idea, and I want you to look at that first bullet point down there, is when we accept the risk, we need to go ahead and do our regular old marginal cost, marginal benefit. A lot of times, that potential loss is less than whatever risk mitigation strategy that we're going to pursue. So there's another bullet point on oil fields and gas, and it could be commodities with farmers. It could be almost anything. Those of you who are paying attention, in the mid-2020s, there are substantial tariffs going on in the United States and throughout the world. And so good financial risk managers have to figure out, all right, do we want to accept this risk, or do we want to hedge it? We can avoid the risk by just not pursuing any kind of a strategy. Think about it in terms of a product line. I mean, an investment bank could just say something like, what? We've gone through the FRM program and we know about rogue derivative securities traders. And so we're just not going to have a derivative trading booth or division. We'll just avoid the risk. We can lessen the risk. This is what I was saying just earlier. We can hedge by signing some kind of a contract. But look at that second diamond point. This is probably what the likely exam is. give a scenario, and then you've got to do, well, we have the words cost effective. So I'm going to do the same thing I did a minute ago. This is marginal cost versus marginal benefit. And then we can just completely transfer the risk through an insurance contract or credit default swap or securitization or any of the other many topics that we're going to talk about throughout the program. Now, those of you who've been through the CFA world, you might remember that the CFA Institute has historically used the terms an investor's ability to take risk and an investor's willingness to take risk. And so that's a good analogy here. So we've got two words. We've got risk appetite. So appetite, that sounds an awful lot like the willingness in the CFA world. And the risk capacity, that sounds an awful lot like the ability. I'm going to show you an illustration here on the next slide that'll really help you distinguish between the two. But what GARP does here is they also throw in the firm's current risk exposure, and they call that a risk profile. But before I do that, make sure you get a good definition of this risk appetite. So it's a written document, probably written by the chief risk officer in conjunction with the board of directors. But then the second and more important component is that this is the day-to-day evaluation. I mean, it's one thing to say something like, okay, as the chief risk officer, this is how much risk we are able to take, that our appetite enables us to take. Now, we can measure this through beta or standard deviation or value at risk or delta or lambda, and we'll do all that stuff throughout the program. But it's another thing if, at 4:00, one of our traders comes to us and says, I was supposed to take this much risk today, but I took this much risk. Now, what do we do? So look at the bottom there. Risk specific statements, firm risk policy, risk limit determinations. Let me tell you just a quick story. I can't help but get my Seinfeld references. Do you remember when Jerry was renting a car and they didn't have a car, and he said, you know how to take the reservation? That's kind of like the written document, but you don't know how to hold the reservation. That's like having a car there for him. So I think a great question is probably distinguish between those two and figure out how they complement each other. The second one, of course, is a function of the written document, and that's the application. Now, here's this illustration that I was telling you about. So remember, that risk profile is kind of like the current risk exposure. And so that is below the risk appetite, and then that's below the risk capacity. So if you can remember this little illustration, you ought to be able to answer a question on the difference between and among the three and where they should fall. Notice the dotted lines. These are probably some kind of an upper and a lower, kind of a benchmark point, kind of a reference point. I think the chapter calls it a trigger point. And that trigger point then, that goes hand in hand with whatever the governing bodies are telling us what we need to do. All right, let me swing back to that first chapter. Remember, I gave you the identify the risk, quantify the risk, and manage the risk. Remember, that's just Jim's kind of evaluation. Remember, there were a couple other things that we talked about in that first chapter. But the idea here is that we're going to go ahead and be a little bit more sophisticated when we identify the risk. GARP calls this risk mapping, and so you can think of it as a map. Now, back in the old days, when my wife and I would go someplace, we'd get the map out and we'd go, you got to go here. So that's how I visualize a map. You guys just hit your little map on your phone or on your screen right inside of your car. That doesn't give you kind of the great global sense of mapping, but this is what GARP wants you to do, is think about opening up a map of, the United States or England or Germany or wherever you guys are, and look at all the stuff there. Think of the mountains and the valleys and the volcanoes and the lakes and the oceans and the hills and the valleys, all that kind of stuff. So look at what GARP tells us. Identify, assess, and visualize potential risks. Now, what I always tell my students is when we're talking about potential risk, always think about an Excel spreadsheet. And we start over here on the left-hand column with just some risk, call it interest rate risk. And remember, we had that big slide where I asked you to take a picture of it with all those different kinds of risks. So you think about what interest rate risk means and then mapping it, of course, and I'll just do a simple mapping here for you. Let's suppose we have a bond. We need to know the duration of the bond and we need to know the convexity of the bond. And then based on those two risk metrics, we can do things like assess and visualize those potential risks. So what GARP is asking you to do here is not create an Excel spreadsheet, but I think it's a great visual tool. So there we go, a chart or a matrix or whatever it is that you feel comfortable with. Now, of course, there are lots of things that are going to result from this risk mapping. Maybe we'll do some stress testing as a result of the mapping. Maybe we'll use Monte Carlo simulation. But remember, this mapping, the way I think of it, is really just a matter of being more sophisticated in identifying the risk. Now, don't forget the assess and visualize potential risk component of that. When I'm in front of my class, I make up a problem. I'll always say something like, oh, here's an equity manager that has, $50 million or $500 million in equity securities. So I just make up that amount. And then typically we use that notional amount to hedge with a futures contract or an option contract or whatever it is. Now, right sizing has something to do with that notional principle that we use in any of those derivative contracts. But what GARP wants you to learn about right sizing is not only that notional principle inside of the derivative or the insurance contract or whatever it is, but how does that notional reflect all of the stuff that's going on inside of the board of directors. Now, we just spent just a little bit of time talking about the risk appetite. And so this is the artistry that GARP is hoping that you guys learn so that you can answer some of these really, really good questions on the exam. That right sizing means, the word sounds like, okay, here's our financial institution, and this is the right size for our risk management process. And it's probably not that simple. And that leads back to what the summary tells us, that there are no easy answers. That's why we have boundaries and we have upper limits and lower limits. Notice that second bullet point there: efficient approach to managing risk. Once again, trading off marginal costs versus marginal revenues. The toolbox, you guys know about all those tools: derivatives, insurance contracts, all sorts of fun things. Of course, the next question is, how do we go ahead and dip into let me go back here quickly. How do we dip into this toolbox? And how do we look at these action words: evaluate and implement this kind of a hedging strategy? What we're going to do is we're going to use some derivatives. Now, what GARP does for you in this part of the chapter is take a look at just swaps, forwards, and futures contracts. And so the difference of them will be tremendously investigated going forward. But let me just give you, a quick idea about these three kinds of derivatives. So a swap contract is really just a matter of looking at life as the grass is greener over on the other side. So essentially, if you own, let's just say, a bond that pays a fixed coupon rate, and your neighbor owns a bond that has a floating coupon rate, and the two of you have different ideas about the direction of interest rates. One party might benefit if rates go up. One party might suffer if rates go up. So if you have competing ideas about future interest rates, then you might want to enter a swap. And that's essentially what a swap is: two economic positions. So we're hedging, but it's not a perfect hedge like I talked about the vice. Now with a swap, you can get the vice and you can go like this. But the vice is a great example using forward contracts and futures contracts. And essentially, these two instruments accomplish the same thing. They lock in to a future value, but they do it in completely different ways. I mean, a forward contract is a customized contract, meaning that you could go to a financial institution and you could say, I want a contract for this amount on this day, and I'm not taking any variability, and they'll just write you that forward contract. Now, of course, it's difficult to get out of a forward contract because it's customized. You're not going to be able to sell this in a secondary market. That's why, and you'll hear this big story at some future conversation, that in the mid 1800s, there were 12 dudes who got together and said, you know what, let's start a futures contract, a futures market. So these are standardized contracts. But for now, you can just imagine that forwards and futures, they lock in future value. So look up at the top of those two teardrop points. What do these contracts do? They negate or offset losses or gains. So I want you to think about this. You're going to hedge because you're operating naturally in the spot market, whether you're a farmer that's exposed to the price of wheat or corn, or whether you're a financial institution that owns a bond or shares of stock. What you can do is you can layer your spot position with a derivative security. And that's what we do. We lay a derivative on top, which takes our volatility from this much all the way down to this much or this much. If you have a perfect hedge, you can completely eliminate whatever that underlying risk is. Why are we motivated? Of course, if you can lock into future values, you got financial stability. You don't have to worry too much about bankruptcy. You don't have to worry too much about financial distress. Now, one of the really good questions that GARP could ask you is a combination of hedging advantages and disadvantages. And for those of you who watched one of my videos where I try to explain a little bit about what GARP is doing these days in terms of asking questions, they like to pair a question. So there'll be a question stem, and then there'll be two questions. Hey, which of the following is an advantage, and which of the following is a disadvantage? So in your A, B, C, and D, you'll have a choice to pick one of these, one of those. So let's go ahead and work through these advantages and disadvantages. Remember back in your very first corporate finance class, you learned that the goal of the business is to maximize shareholder wealth. And the first thing that you learned was, well, firms do this by trying to develop product lines that have sustainable and high operating cash flows. But another way that firms do this is by minimizing their weighted average cost of capital. So the way GARP approaches this is that we're reducing the volatility of earnings. I always like to look at it as we're reducing the volatility of revenues, locking into a revenue. We're reducing the volatility of expenses, locking into an expense. So that, of course, reduces the volatility of what I always tell my students as margins. But of course, here in this, FRM world, we need to worry about the very bottom of the income statement. So reduce volatility of earnings. So that's an important one. Skip over to 4. What this does is that if we're locking in, this gives us an idea of what's going to happen in the future. So there's higher predictability of both revenues and expenses. And what this does, this predictability in this section, what GARP does for you is expand this mostly to the international environment with currency risk, which means that we can use swap contracts to go from this risk all the way down to this kind of risk in the foreign exchange market. Go back just one to cash flow benefit. Of course, if we're reducing volatility, then we're going to be able to hedge that risk as well. Capital protection, if we're locking in a future value, then we can lock in that certain amount. GARP uses the example of COVID. I ask my students all the time. I say, now my students these days, they were like 8th grade when COVID hit. But I say, look, suppose that your parents, had $1 million portfolio, and what they decided to do was take the short position in the S&P 500 index futures contract on I don't remember. What was the day? March 5th or March 20th, whatever the day that we shut down everything and there were stock market crashes. How much better off would your parents be today if they would have hedged at that time? So capital protection. And then all the way at the end, remember I've said this, and I'll say this regularly, that it starts with a really highly skilled chief risk officer and then goes back to the board of directors who've established the strategic direction of the company, but also established a risk culture. And so hedging comes as a part of all of this stuff, which leads into better corporate governance. Now, of course, there are some disadvantages. There are transaction costs. I always tell my students, look, forward contract's pretty cheap. Futures contract, that doesn't cost anything. Now you have to worry about daily settlement. But if you use an option to hedge, which we haven't talked too much about, in fact, maybe not even at all in these first couple of chapters, but options can be super costly. And in fact, they can cost so much that firms avoid using those options. Let's skip down to number 3 here, complexity. With a forward contract, that's super simple, right? Futures contract gets just a little bit more complex because there's an extra third-party risk in there with daily settlement. But if you layer your spot position with an option and a swap and a futures contract and a forward contract, it can get really super complex. You're going to learn about Procter & Gamble, who in the early 90s decided to hedge about $40 million worth of an interest expense. They ended up losing $400 million because they layered foreign exchange swaps with futures contracts. It really was kind of a silly thing. What your chapter does is say something like, there's an example where, okay, we're hedging, we have this complexity, and we win in every scenario unless some price, maybe it's an interest rate, maybe it's a commodity price, falls within this little narrow range. Well, that's what happened with Procter & Gamble. So look, I keep telling you guys that you need to identify the risk. Identification means identifying the complexity. That's why that risk mapping is so important, because that leads us to figuring out what are potential losses. And then there are these unintended risks as well. We have a whole section on wrong way risk. Wrong way risk simply means that, hey, if something goes bad for you in one market, it might lead to something bad happening to you in another market. So you're going the wrong way. You're going the wrong way. You guys remember that great Steve Martin line in Trains, Planes, and Automobiles, when he and John Candy are driving down the road and the couple comes up and says, you're going the wrong way, you're going the wrong way. And they're going down the highway the wrong way. Steve Martin says, how do they know where we're going? Super fun stuff. And then what happens here when we're hedging is that we're trying to lock in a future value, which takes away the idea that we can make profits. And I always tell my students, look, if you're hedging, you are not trying to profit. You're trying to hedge. You're trying to reduce risk. If you reduce risk, well, then that whole graph of the risk and required return thing that we did last week, well, that falls down by the wayside. So, we lose some flexibility. Yeah, a lot can go wrong. Misunderstanding the type of risk. That was the Procter & Gamble. Model risk. If you use value at risk as the primary metric, remember we said that this was not a coherent risk measure in that last chapter. And what that might do is lead you to make some erroneous decisions that can bring about massive losses. That's why it's so important. It's so important that you couple your value at risk conversations with expected shortfall. Poor monitoring, overly complex hedging or excessive hedging. And then this MG refining and marketing, what they did was they took a position in a derivative and they were losing in the derivative, but they were winning in the spot market. So this was a good hedge. However, the losses in the derivative market were so massive that they had to meet some margin calls. So they just said, you know what, we're out. And so once they went out, they lost in the derivative market, but they weren't ready to execute in the spot market. So then the spot market turned against them, and so they lost a couple billions of dollars. So this goes back to the purple: poor monitoring, overly complex hedging, excess of hedging. I'm not sure what's going on here. But look, what GARP wants you to do is to be able to manage all of these risks, right? Art and science, so that you don't have to go to your supervisor and say, oh, I'm really sorry, I lost $1.3 billion today. All right, what are some of these risks? We've got operational risks, we've got financial risks, pricing risks, foreign currency risks, interest rate risks. So how do we do this? Well, we enter forward contracts and futures contracts. And so there we go. Look at the second diamond point. A guaranteed, there's a locked in future price, a locked in future values. So we can sell forwards if we're the producers. We can buy forwards if we're the consumers. And so it's probably a good idea to think about life from a producing standpoint and a consuming standpoint. And GARP is highly likely to give you a question and says, okay, you're a farmer. What kind of position do you want to have? You're a grocery store. What kind of position do you want to have? And then what are the advantages? And so look, I mean, in that little simple sentence I just gave you, there's probably 4 really, really good questions in there. One final thing down there: airlines protect their profit margin. This has everything to do with locking in a future value, with managing cash flow, better corporate governance, all that kind of stuff. Foreign currency risk, we do the same thing. I mean, I used to teach an international finance class. I haven't done this in years because we have another dude who does that. But of course, we've got corporations who sell their product lines throughout the world, so they have to worry about currency risk. So they're going to use a forward contract, they're going to use a futures contract, but they can use currency swap, they can use forward rate agreement, they can use all sorts of these contracts that are going to lock in the future value of their currency. Now, with a swap contract and a forward rate agreement, what you can do is lock in a series of future currency values. If you use a futures contract or a forward contract, you're just doing it one at a time. And so a lot of companies will just use a futures contract, and then that matures, then they do another futures contract, and that matures, and they just keep rolling these things over. And that's easy to do, but it's even easier to enter into, let's say, a 5-year currency swap in which you do this. So a currency swap and a forward rate agreement, and you'll see this as we move through the program, it's really just a series of forward contracts or futures contracts. And then interest rate risk, I gave you this example just a few minutes ago. With owning a bond, you have interest rate risk, so you got to worry about the duration of the bond and the convexity of the bond. Notice some of the bolded words that we have in here. Avoid excessive debt, overexposure, what are acceptable debt levels. Combine that acceptable debt levels back with the right sizing, and notice what the last part of this section does is it relates to a risk profile. I want you to get out your phones like I do in almost every recording, and I want you to take a picture of this page and this page. I'm not going to spend too much time on here because these are pretty self-explanatory, but be prepared for a scenario under which in the question stem you're given a description. And then the question says, hey, identify what specific risk limit and the potential weaknesses. And so you'll have this right in front of you. All right, did you take a picture of that? Do I need to pause? All right, take a picture of this. Notice that in these weaknesses, there's a couple of things that I mentioned in that chapter 1. We talked about coherent risk measures and expected shortfall. But notice up under concentration limits, and this is also obvious, although we don't mention correlation in here, you can think about correlation coefficients and copulas as potential weaknesses because they're not going to capture that historical correlation during, kind of normal markets. And so that's kind of a theme here, and I bet that helps you answer a question. Yeah, what are some limits here? Yeah, derivatives are going to have limiting and limitations. We're going to have offsetting positions. Remember that I did give you this idea that you can have a perfect hedge. I didn't give you the two conditions. I'm going to give you those now. To have a perfect hedge, the asset in the spot market and in the futures market, let's say it's copper. You're a copper mining firm and you take a position in a copper futures contract. So in order to have a perfect hedge, you have to have identical assets, identical underlying assets. And the second part is that the timing has to match. You're going to mine the copper on the exact same day that you're going to have the copper futures contract mature. If you have those two things, you can have a perfect hedge. You can totally eliminate commodity price risk. But notice the limits there. If those two things are not, if the assets don't match and if the timing doesn't match, you're going to have basis risk. So what I call not being able to have a perfect hedge, GARP calls not being able to fully offset the loss. And there's the example down at the bottom, jet fuel, crude oil, natural gas, gasoline. I mean, there are all different sorts of kinds of spot assets that don't have a perfect match inside of the futures market or even the forward market. Now, we'll spend a lot of time on the difference between physical places. These are exchange traded derivatives and the electronic markets, like the over-the-counter markets. So I want you to think about this, that, that in the over-the-counter market, you can tailor the contract. You can do whatever you want. And a financial institution is pretty much going to go along with you as long as you have the capacity to support that. But in the exchange-traded contracts, like a futures market, these things are standardized, so they don't have customization. And that's why you have to have this thing called daily settlement. So make sure you know the difference between the exchange-traded derivatives and the over-the-counter derivatives. And I'm pretty sure I came up with 10 pretty good, I wasn't really counting, maybe you guys were, 10 really good potential exam questions for, to each of those learning objectives. So what I want you to do is I want you to go to the end of this chapter. There are 20-some true and false and multiple choice questions in there. I bet you get most of them correct, and that'll be a good sign. There's one in there that I want to call your attention to. There's a true-false question that says something like, hey, experts say that airlines should always hedge their fuel risk or commodity price risk. And I would answer that as a yes, but of course the answer is no. As a component of how do firms manage financial risk, some firms may want to accept it, but depending on the economic conditions. But I tell my students that if I were an airline or a farmer, I would hedge the risk, maybe just 1%. So I came up with a different answer. But of course, the GARP answer is the correct answer. So hey, thanks for watching. And as always, good luck studying. I hope I've helped you prepare for these two questions on the exam. So let me give you the Kramer thumbs up and enjoy the rest of your day.